Good afternoon, everybody, and welcome to today's Open to Export webinar about the risks involved in markets around the world and how you can manage them. My name is William Barnes-Graham, and I am a Senior Content Editor at the Institute of Exports and International Trade. Open to Export is a free online service helping small businesses get ready to sell overseas through our step-by-step articles and guides, regular webinars, our Export Action Plan tool, and our quarterly competitions. You can find out about all of these on our website at www.opentoexport.com. Open to Export is powered by the Institute of Export and International Trade, the UK's professional membership body for traders. Endorsed by the World Trade Organization and the International Chamber of Commerce as a small business champion, we offer a unique range of individual and business membership benefits, education and training catering for beginners through to master's degrees, and an always exciting and prestigious program of events celebrating UK businesses' exporting achievements. We will be running a live Q&A later in the session, and you can ask questions at any point using the question box on the control panel to the right-hand side of your screen. The general principle here is that we'll only ask questions that are relevant to the broader audience, so you won't be able to go into company specifics as such. But if you do have specific questions, we can refer you to our technical helpline afterwards. We're delighted to have three fantastic speakers today. Gary Wingrove from Bibby Financial Services will later on give an overview of how exporters can mitigate some of the financial risks of global trade. And as ever, we are very grateful to Bibby for supporting our webinar programme. Before Gary, though, we'll have Brook Horowitz, CEO of IBLF Global, who runs the Institute's risk management training courses. And Brook will also be joined by John Burbidge-King from Interchange Solutions to discuss some of the human risks involved in trade, particularly around corruption. So over to you, Brook and John.
Thank you very much, and hello everybody. Welcome to our webinar today. We'll be talking about risk management in markets beyond the EU. Next slide, please. Of course, we think that we will be leaving the EU on 31st of October, but who knows? But whether we are or not, there are many markets outside of the EU. A lot of companies, small and medium-sized British companies, have been trading quite happily within the EU for many years. But that's almost like not exporting, it's just internal trade. But when we start the challenge of moving into emerging and developing markets, then we will come across a whole lot of other kinds of risk. We'll talk about culture risk, corruption risk, and Gary will be talking about financial and transactional risk. So between the three of us, I hope that we'll be giving you a good picture of the sort of things that you need to know about when you venture beyond the EU. Next slide, please. Now, the forecasts for the EU, as you've been hearing in the news, are pretty flat, and some people even think negative growth. But beyond the EU, there is quite a strong trend towards growth. Many of the developing markets, of course, are starting from a low position, but are growing quite rapidly. And clearly, if you're trying to link into a market that is growing, then you need to look outside of the EU. Next slide. Next slide, please. Now, there are many markets to choose from out there. I've just mentioned some of the big markets, the BRIC countries and what are called the mints, which is Mexico, Indonesia, Turkey, Saudi Arabia, Nigeria. If you just look at those, I mean, they're all huge GDP markets, and if you go to the next slide, you'll see that they're all rapid growth. The difficulty, though, is that none of them are simple markets to deal with. None of them. The World Bank Ease of Doing Business Index is a very helpful way of looking at risk in countries around the world. It ranks all the 159 countries in the world according to 14 buckets of how easy it is to do business in those markets. And that the countries that I've highlighted here are the same GDP, high GDP markets, and they all, where there is a darker color, it is high risk. And you can see India in there, of course, and Nigeria, very dark, but China, Russia, these are all complicated markets, Saudi, South Africa. So there is nothing simple about doing business in these markets. And if anybody tells you, oh, just go ahead and export, well, it's not quite that simple. Next slide, please. Now, I just want to focus in on a few countries. I'm doing quite a lot of work in Southeast Asia, and just looking at the Southeast Asian countries. This is another very helpful tool that I use when I'm looking at risk in markets. This is the World Economic Forum's what's it called? Sorry, the Global Competitive Index. And again, it's a ranking system, but they actually ask people who do business in these countries what the most problematic factors are. You can get all this online. It's very easy, and you can drill down into a lot of detail if you want it. But if you take one of the biggest markets in the world and one of the highest growth markets, Indonesia, you've got corruption right up there at the top. And you'll see corruption in most of these markets in the top 3 to 5. You've got inefficient government bureaucracy, you've got access to financing, all of these things, inadequate supply of infrastructure, policy instability, all these things must have a real impact on exporters and investors going into these countries. So you do need to understand what these issues are before you go in there. Next slide, please. Similar situation in Philippines. Corruption's a little bit lower down on this assessment, but access to financing, foreign currency regulations, inefficient government bureaucracy. Next slide. Vietnam, this is a country where I spend a lot of time, and it's a lovely country. People are so friendly and wonderful to work with, and I could think of nothing better than just taking myself off there and setting up my own business. But again, inadequately educated workforce, access to financing, corruption, poor work ethic. So these are things that are just part of the national culture, they're part of the economy, there may be traditional, historical reasons for this. Some of these countries have come out of communism, which is again, everybody thought that Russia and so on would be an easy doddle to just move out of the communist era and transition into capitalism. But of course, 25 years on or whatever it is, we're kind of no further forward. Vietnam is a bit of a jewel in the crown of countries that have transitioned from communism, but still the bureaucracy, the corruption is still highly embedded in that society. Next. Thailand, again, it comes from a slightly different tradition, but same sort of things. Next slide. Next slide, please. So what are the high-risk areas? What does it translate into for companies like yourselves thinking of going into these markets? And the top risk area is how you are represented there. And John and I will talk about this in a little bit more detail in a few seconds, but third-party agents, if you have an agent there or a distributor and they're working under your name, they may be using your brand, and they really are your responsibility. They're your responsibility from a business point of view and a commercial point of view, but they're also your business from a legal point of view in the UK, and we'll go into that in a bit more detail in a minute. Then there are all sorts of things that you that we need to draw your attention to. For example, I'm not going to go through every single one of these, but gifts and entertainment. In most of these countries, giving a gift or inviting somebody out for an expensive meal or even a not so expensive meal is part of the culture. A lot of good business is done over dinner, and or you might want to entertain somebody abroad. You might want to take them to Disneyland or something like that. Well, nowadays that is becoming quite difficult, because under our own legislation here in the UK, you're not really supposed to do that. You're not supposed to get an advantage over your competition. You're not supposed to distort the market by these kind of gifts. A gift or a very expensive, disproportionately expensive meal is just about the same thing as a bribe. There are other areas that are, you might not get into these yourself, but if your employees or suppliers have got too close a relationship, in many of these countries, everybody knows each other. There's friendships, there's family relations. Maybe your distributor's uncle is a high-level political figure in the government and is the person making decisions about allocating resources to your industry. Well, you've got a conflict of interest there, and even though the agent or the distributor may be a separate company from yourself, if your company is going to be benefiting from that relationship, then it's a red flag for you. You need to be understanding of these red flags. Let me just go on. We won't have time to go into all of this in detail. Let's have the next slide, please. Now, I'm going to hand over to John, who's going to just give you the sort of picture of how you go into these markets and take the necessary precautions. John.
Thanks, Brooke, and good afternoon. John Burbidge-King, good afternoon to everybody. Exporting is a great opportunity, we know that, and managing how to export is no different to managing anything else in your business, be it the finance, the payroll, other things. It's just looking at processes in a different way. So if this was teaching Granny to suck eggs, I apologize. I'm going to back to some basics here, because I guess there are some people that perhaps haven't exported or not quite certain how their exporting is going at the moment. But here's a common story. Get on the plane, fly from the UK, go out to one of Brooke's markets around the world and meet someone in the bar, the hotel that night or the following day, or simple meetings, go to a trade exhibition or similar, and they suddenly become your friend. And who knows, after a while, you start to talk about markets and you engage them. So that's quite a common practice, but not a very well oriented process. So let's come back to a better way of doing things. Next slide, please. So some obvious questions exporters need to consider. Well, why are you doing it in the first place? Is it because you want to expand your business? What's the business driver behind doing this? Lost markets, increased revenue, new opportunities, picked up a lead from DIT, someone sent you a telephone call. And then the next challenge is, where are you going to export and choosing your markets? That's really, really important for more than obvious reasons. But the next one is how to get into them. There's stacks of export advice and expertise. It's picking it as you go along. There are UK government websites. There are actually good ones on the US Chamber of Commerce websites, and the CIA fact book, you just put that into Google, will give you a huge amount of data on any country in the world, be it the finance, the defense, products, services, population, etc. A key issue for exporters is your product suitability. And what's the cost of adaptation? It might be perfectly good in the UK or in the EU, but it may need considerable amendment, for example, to meet with local regulations in countries like Brazil, Thailand, etc. Now, most smaller companies, the big challenge is sales resource, language, understanding, regulation, finance. So unless you've got 159 or 186 linguists in your company, in your sales force, multiplied by the different dialects, language presents a problem. Then eventually the cost and the need to do a business risk assessment. For example, a day trip out to Vietnam is probably going to cost somewhere around £3,000 for a proper visit, and you may not get anywhere during that visit. So export costs mount up unless you've done the planning and the execution. So the planning, the process, and the execution is key. Next slide, please. So most companies, small and large, they think about their local representation. I don't have all those linguists. I'm a small company. I employ 1, 5 salesmen, 20 salesmen. I cannot afford to have someone in every place around the world. So how am I going to find these representatives to help me in the market? Well, local DIT offices, companies in your sector, web research. But on recommendations, particularly in country and particularly from, for example, officials in ministries or people that make a recommendation you're not too certain of, buyer beware. It could be a person that has been recommended to you because that might be the conduit they want to use for illicit activity. And blag. I'll come back to this right at the end, but you will find that people that want to represent companies, they might be trying to put notches, metaphorically speaking, on the revolver to pick up agency agreements with a whole raft of companies to show how big they are in the market. Be careful. In many countries around the world, there are local laws protecting agents. South America is particularly difficult, as is the Middle East. And in Saudi Arabia, you have to declare, as in many countries around the Middle East, who is acting on your behalf, particularly in government deals. And that can be problematic. So it requires background and due diligence, not just their business ethics, but their suitability to deal with your business. I did some due diligence on a company in Thailand about 2 years ago who were representing a high-tech company, but believe it or not, when the due diligence came out, their main business was chicken noodles. So a little bit of ordinary due diligence before getting wedded is a good idea. And from an anti-bribery view, which is exactly where we're going to go in this, to record that and log it properly is fundamental for the safety of your future in those markets. Agents and distributors may have connections, good and bad, and the purpose of the due diligence is to get rid of the bad ones and find out where those good connections are. Now, rounding off, agree the business objectives. Don't be shy of asking them what it is you want them to do and get it down on paper. We do it for employees, for bonuses and targets. These people are essentially extensions of your sales force. So that should be there and put in the contract with the appropriate clauses to show that you are managing your business properly. Then we come to management. Many companies really don't squeeze the value out of their intermediaries, their third parties, benchmark and measure them. Simply appoint them and hope to goodness it's going to all work out on the day. And in those markets where it is quite difficult and there are strong legal requirements in the management of agents, termination can be very difficult. As they say, marriage is easy, divorce is difficult. And most importantly, in terms of business ethics and the law, make certain you document what you've been up to. Next slide, please. So there are some traps in the appointment of third parties. They are of great value, but the first is their connections. And we've talked about that, and Brook has already mentioned connections, particularly to politically exposed persons. They are people that are in government. And within the Bribery Act, just be aware, which Brook's going to come on to in a minute, that foreign public officials can also be, under the UK Bribery Act, managers in state-owned companies. And given in markets like India, like Brazil, like China, many of the companies are state-owned. Commissions. It is very common for salespeople to fall into the trap to be persuaded by the would-be agent or distributor, this is the usual commission in this country. So from countries like Indonesia, it might start off at 25–30%, and you might go into countries like Iceland, Germany, where it'll come down to 3%. At the end of the day, the commission is the payment for the value they're delivering to you. And the larger the commission, particularly on large deals, you need to think about, one, how much of your shareholders' funds you're spending on commissions. And secondly, what is left on the table to bribe? And these things need to be factored in. The method of payment. Your bank will ask you when you open up immediately to your new exporting arrangements, who is it, where is it? And if it looks dodgy, you will be shut down with that channel fairly quickly. Payment to a recognized bank, it should generally be paid in the to the account of where either the a third party lives, their domicile, or where they are doing business on your behalf, because the risk there is offshore and tax evasion. And only 2 days ago, I was dealing with a case on behalf of a UK PLC that has a problem with a distributor that's being closed down due to some very serious tax evasion cases. Any requests out of agreed terms, requests for increases in commissions at tenders, extra taxes, these should be warnings to you, red flags, that whilst you have an agreement, your third party is stepping out of order, particularly if it's close to a contract. And in fact, there was a British company called the CBRN team, which supplied nuclear, chemical, biological warfare kit to Uganda during a state conference that had extra taxes demanded on it. It paid them, and it turned out to be a bribe. And the company folded as a consequence of the prosecutions. Brooks already talked about hospitality, travel, and of course, as we're going to come on to in a minute, the law, local, and the UK. I put local in there because no one wants to spend time in jail, as Peter Chapman did in Brazil for 2 years when he was apprehended on an extradition order for corruption. Next slide, please. So, bear in mind that your local rep is likely to be very different to you in business, except if you're a business owner or a small business. They're likely to be very entrepreneurial. They will promise the earth. They will connect to everywhere. They will have, though, all the resources you need, if properly managed and properly looked at, to help you to export efficiently in your market. So that's all I want to say really about the main area, which is the appointment of agents and distributors, except to say that in bribery cases, 80% of the cases to date, both in the United States, Europe, and the United Kingdom, have come about due to a third-party intermediary. And at that point, I'll hand over to Brooke.
Thank you. Next slide, please. So the key piece of legislation that you need to be aware of if we're focusing on the corruption risk is the UK Bribery Act, which you probably heard of. There was a lot of discussion of it when it came out, and it's gone a little bit quiet. There haven't been a huge number of cases under this. In fact, there have been a lot more cases under the US equivalent, which is called the Foreign Corrupt Practices Act, FCPA. And there have been some very, very big cases, showcases with multi-billion dollars in fines and penalties and some imprisonments as well. The fact of the matter is this is quite draconian legislation. It's existed in one form or another in the UK or in the US for many years, but the enforcement has completely changed in the last few years. And although it could be argued that small and medium-sized enterprises like yourselves are below the radar screen, this legislation is run by the Serious Fraud Office. I mean, they're only going to deal with serious fraud. That's the argument. And it's true that their resources focused on the big companies like GSK or Rolls-Royce or whatever, these high-profile cases that you've probably read about. However, that doesn't mean that they're not investigating small and medium-sized enterprises as well. And occasionally you do see a case that comes out on that. It doesn't get the big publicity of one of the huge brands, but it is there. And of course, there's quite a few cases that are probably under investigation, which just have not come to court yet. So it's we probably just don't know about them. I think it's a matter of time. These cases will be brought to justice, and of course, you know, if it's a very small issue like a facilitating payment, then yeah, the punishment might be less. And in the US, by the way, you can give facilitating payments, which are just kind of, you know, sort of extra bonuses to the customs official, but under the UK Bribery Act, you cannot. There is this new concept in law about the corporate liability offence, which is your company is liable, not just the individual. It includes company-to-company bribery, and it's also focused on bribing foreign public officials. And as John just mentioned, state-owned entities are treated as government agencies. So you're, you know, somebody working for the purchaser of a state-owned enterprise, even though he may be looking as though he's from another company, is actually a state official, and therefore it will be particularly under the scope of this legislation. Any bribes through your distributors and agencies paid by your local distributors and agencies, even if they're separate companies, but they're doing it in your name, if that is discovered in a third country, is going to be against the law. I mentioned facilitation payments just now. The extraterritorial application is the same case, that it could be, I don't know, it could be a Vietnamese partner of yours giving a bribe to a public official in Thailand on your behalf, as it were, and you know, you think, well, what's that got to do with me? I can't control this. Well, strictly speaking, under the Bribery Act, you are liable. And this issue that we're going to be talking about is about the culture of bribery, the way business is done, which is very much, you know, in this space of entertainment and gifts and ambiguity, is not a defense. So the question has got to be for your company on this particular issue. This is not the only risk that you will encounter, but it's a big one, as I've tried to show you earlier. On the issue of bribery and corruption, do you have adequate procedures to prevent bribery? Next slide, please. Well, you do need to know the law. You don't have to read the whole legislation. It's not, I mean, it's all very well written and clear, as you'd expect, but there are these, you can look it up on the internet. There's a guidance document from the Department of Justice, and there's even a quick start guide, which is about 9 pages with illustrations. And then, you know, you have to look out as well for the US legislation, especially if you've got some kind of business going on in the US. If you have a US footprint, then you could also be liable under the FCPA, or the French new legislation, Sapin 2, is may also be relevant to you if you have a French profile. And then, as you know, you've got to also be compliant with domestic legislation, and that may not have been such a problem, because, as we know, this kind of issue is one that many countries turn a blind eye to. The enforcement is poor, the rule of law is poor, but I point to the biggest market of all, China, where there's an anti-corruption campaign going on, and the very first company that came a cropper under that legislation was GSK. Okay, next slide, please. So I just want to just refer you to one other thing. This is a AntiCorruption Toolkit for small and medium-sized enterprises, which I helped put together a few years ago under the at the request of the G20. You can find it online. It's well, you can see the link there, but if you look up AntiCorruption Toolkit and then my organization, IBLF Global, you should be able to come across this. It's a very simple thing to use. It raises and discusses these questions that we've been touching upon now. Next slide, please. And if you're interested, John and I will be doing an Institute of Export seminar on 5th of November. I think we may have forgotten to put the date in there, but it's 5th of November in London, and we'll be discussing these issues in great detail, and you're also getting you, the participants, to share your experience of these. We'll not just be talking about bribery and corruption. That will be one of our topics. We'll be talking about financial risk, intellectual property risk, and how to set up a basic risk management system in your company. We'll also be discussing some of the cultural gaps where the different ways of doing business are the areas which you need to watch out for. So bridging the cultural gap, and of course we'll be talking about what to do if or when things go wrong. So I just mentioned 5th of November. Do register if you're interested. There's a link on the export.org.uk pages. Okay, next slide. So that's it from me and John for the moment, but we're still here. And now I'd like to hand over to Gary, and we'll all be happy to take questions at the end of Gary's presentation. Go ahead, Gary.
Thank you, John, and good afternoon, everybody. Next slide, please. Today, I'd like to touch on some of the challenges and risks involved when exporting to markets outside the EU, areas to research, and working with financier. Next slide. But first, just a quick note to get the boring bit out of the way. Who are Bibby Financial Services? We're a leading independent financial service provider. We're a family-run business which started back in the early 1800s as a shipping company. We now have a distribution arm and a financial services arm. We have over 9,500 clients with a combined annual client turnover of 9.3 billion. We employ 1,200 people in our 40 offices across 14 countries. And we offer funding for all types of businesses, mainly in the SME market, whether it be construction, recruitment, or manufacturing. Next slide, please. There are many factors to consider when exporting abroad. So it's important that you do your research thoroughly. Failing to do so may lead to a costly mistake for your company, both financially and reputationally. So whichever market you choose, it's essential that you do your due diligence. Research your buyer, agent, distributor, and your chosen market, as John and Brook have already discussed. Does your buyer exist? Now, this may seem obvious. You've spoken to them, you've received a purchase order, but we've seen instances when it comes to collect the debt has disappeared. After further due diligence, even something as simple as going onto Google Map, turns out this big warehouse or business you're expecting, it turns out to be a local sports bar. Does it make sense? Again, we've come across, you're doing business selling jeans, but the people trying to buy your product are an engineering company. Do they have a web presence? In this day and age, you would expect most businesses to have some sort of web page to promote themselves and their product. But again, look at it. Is it a single page full of mistakes, or is it a bit more professional? All these can be signs of a debtor who is not genuine, who's out there to take your goods and sell them elsewhere and leave you high and dry. Other things to look at are your debtors' financials. Do they pay on time? Have you heard of them? What do their financials tell you? Again, it's also been known that companies have amended their accounts. They look more attractive and therefore gain better credit ratings. And But you can find a lot of this information on the web, as John and Brooke have already said. There is a lot of information out there. But you can also use credit reference agencies. These companies gather a huge amount of information on debtors and their payment performance. However, the level of information can vary from country to country, depending on their laws on what information can be divulged. In addition to obtaining credit reference reports, you may want to take out a trade credit insurance policy, either directly or through an invoice financier. This will protect you against protracted default, which is the non-payment of an undisputed debt, or debtor insolvency. And most providers will also cover political risk, which will protect you from changes in government law and its fallout, and events such as an outbreak of war. When the first Gulf War broke out, we had several clients in the oil and gas industry with exposure to Iraq. The debtor bank accounts were frozen for the duration of the war, and it was many months after the war had ended before we received our payment. This places a huge amount of cash pressure on those clients, those businesses. So if they had bad debt protection, then the payment would have come out a lot earlier. Also, with trade credit insurance, many providers will give you 90% cover, will also provide a debt recovery service. The larger ones usually have offices or agents throughout the globe who can pursue the debt on your behalf because they have people on the ground. They understand the local laws and the territory. And the policy may also contribute towards any legal fees should you have to go down that route. Another useful tool, a credit reference agency and trade insurance policy may provide you, is a country risk analysis, where each country is graded across a number of different rates. And if a trade insurer does not want to cover that market, then you might also give thought to whether you want to dabble there also. One key financial risk is obviously foreign exchange. And with today's uncertain climate, with Brexit, the suspension of Parliament, etc., the pound remains weak against the dollar and euro. And whilst this makes exports more appealing, it can be a big risk for the exporter. You might want to agree an exchange rate, a payment in dollars, but by the time it gets paid, the exchange rate has moved, and suddenly that nice big profit he was expecting has turned into a loss. How do you mitigate this? Well, there are specialist service FX providers out there. These businesses can provide a number of services, including forward contracts, which secure you a fixed rate between two currencies at a specific date in the future. This allows you to calculate what return you are receiving, and you're not open to exchange differences. The other method, obviously, is to get your debtor to agree to pay you in sterling. He then bears the risk, but they might all want to be willing to do so. Then we come on to payment terms. In certain markets, it's often assumed that trade should be undertaken via letter of credit. Some trade credit insurers may only give cover on that basis. This is the document from the bank guaranteeing payment to the supplier on behalf of the debtor. The risk lies with the bank, not with the debtor. However, it should be noted that the bank will only pay out if all the conditions are met, all the documentation is correct. And some research shows that over 70% of letters of credits contain errors, which can negate their effectiveness, with the banks deciding that the errors are too great for them to pay out under their guarantee. This then makes the letter of credit nothing more than a promise of payment. Letters of credit can also be costly and difficult to arrange and organise. Overseas debtors might want to seek longer payment terms, such as 90 days, but this is not necessary. You keep your terms as short as possible. The longer your debtors take to pay, the more pressure on your cash flow. But in a competitive market, this may not be possible. And this is where an invoice financier like Bibby can alleviate this problem, as they will often advance up to 90% of the invoice value upon assignment and releasing the balance once the debtor is paid. Further advantage of an invoice financier would be that they could take the debt recovery on your behalf. So they'll be chasing your debts for you And a lot of these financiers will also have multilingual staff, offices overseas, may even have overseas bank accounts. Despite all this, you may end up with bad debt. What do? Well, if you've got trade credit insurance, and provided all your documentation is correct and there's no dispute, they'll pay out. But only up to 90%. The credit invoice financier, they will obviously fund and take legal action on your behalf, but that's not guaranteed to be successful. So you're left with two choices. You can take legal action yourself, or you can write the debt off. Obviously, the latter not being very preferable. But legal action overseas, as John and Brook have already mentioned, is complex, can be difficult. Laws can differ hugely across the world. So in order to be successful with any action, you need to ensure that your documentation is correct and you've documented all stages. It will be very useful to have a contract and terms and conditions that evidence how the transaction should happen. As I said, recovery can be complex and time-consuming and costly. So ensuring that you have a jurisdiction clause which both parties agree to apply UK law, giving the local courts authority to obtain judgment, is crucial. Once judgment is obtained in the UK, you still need to enforce that overseas, which will mean seeking assistance of local solicitors or agents. But again, your funder or credit insurer may be able to assist. For example, in the Middle East, legal action is generally document-based. Therefore, it's very important your case can be reviewed via the paperwork. You need to ensure you've got your contract, you've got your purchase order, you have a bill of lading, your proof of delivery, your invoice. However, all this must be original and translated in Arabic. This will add further costs to your transaction. And for instance, in the United Arab Emirates, should you succeed, then you'll only be awarded nominal costs. You won't recover all your legal costs. Your court costs could be typically 7.5% to 10% of the actual debt. Something else to bear in mind when you consider taking legal action: is it worth it? If you have a small debt, is the cost of recovering it legally going to be worth it? Again, if you're taking out a trade credit policy, insurance may pay out once judgment has been found in your favour. That is why it's key to try and get your documentation contract under UK law, because you can obtain judgment here. Though not all countries will recognise another jurisdiction's judgment. But an insurer may pay out on that judgment and then try to enforce it themselves. Next slide, please. Sorry, next slide, please. Another key importance is your contract. What is a contract? Well, simply put, it's just an agreement between parties which stipulates the obligations each will undertake, and this is enforceable law. Obviously, they all come in shapes, sizes, complexity. They can range from a one-side piece of paper to 100 pages in depth. But they should all contain key points, some of which are shown on this slide. What are the goods and services being provided? What is the value of the contract? Again, as an example, we had a prospect come to us who had a contract with a Chinese debtor. The contract was capped at $145,000. But when it came to us, it already billed $465,000. When this was pointed out to him, we were told, "Oh, don't worry, we have a good relationship with the debtor. They've signed the timesheet, everything's going to be okay." However, when it came for payment, the Chinese debtor refused to pay, claiming that the contract had been exceeded and that the exporter did not have any purchase orders or statement of works in order to substantiate his claim. Eventually, we managed to take this to a court of arbitration in the UK, and we were awarded $300,000. But it cost us £30,000 in legal fees and 9 months of aggravation. You need to define the timelines. When will the goods and services be delivered? How long will the goods and services be required? Quite often, delivery will be delayed or the service not completed on time through no fault of your own. But it might mean you then incur liquidated damages. This is a deduction from the debtor who would normally take a percentage of the value of your debt for each day or week that the delivery of service has not been fulfilled. Again, you could find your profit margins being impacted. Payment terms. Again, stipulate on the contract what the payment terms are. Is it 30 days from the date of invoice, 30 days from the date of receipt of invoice, 30 days from the lading, or 30 days from when the product's been installed or quality checked? But one clause to be careful of is what we call a paid when paid clause. And that's when the debtor will pay you when his debtor pays him. Now that's fine if that end debtor is somebody like Tesco's, IBM. But if it's another smaller business, you could find yourselves never getting payment, particularly if that debtor goes into insolvency. Your debtor's not been paid, so therefore they're under no obligation to pay you, and you're the person who loses out. Trade credit insurance will probably not cover you in that instance, as no clause has been breached. You may see ban of assignment clauses, and this normally stipulates that the work cannot be subcontracted out to another third party. Usually around recruitment businesses where not all recruiters have staff themselves, but pass the work on to somebody else. Again, you could fall foul of that clause in that contract if you don't get the permission of the debtor that they can use subcontractors. Financiers don't like this type of clause because it also means that the debtor may not want to pay the invoice finance fee. But generally these are simple clauses and the debtor is usually willing to remove them or waive their right to that clause. You might also see right of settle clauses that give the debtor the opportunity to offset any costs incurred by them in completing the order. For instance, again, through no fault of your own, your supplier fails to deliver to you, you're unable then to fulfill your order, so your debtor has to go to another supplier to make up the difference and complete his project. Now, he'll then set off the cost that is incurred in employing that or receiving that goods against your debt, and will probably also include an additional cost for the inconvenience caused. So again, you could find yourself suddenly suffering a loss in the profit you're expected to make. You'll also see termination clauses which set out how long the contract runs or on what point grounds you can terminate the agreement, whether it be in writing or a breach of the agreement, or again, if either party enters insolvency. Sometimes it will also say that in the event of a breach of contract, then they're under no obligation to pay you for any work that has already been undertaken. So be careful of that type of clause. But again, as John, Brook, I have said earlier, jurisdictional clauses is key on where you can take legal action. Always try and ensure that it's in the UK. Next slide, please. Just to recap, because I know time is relatively short, here's a checklist of what to look at and research when entering a new market. Obviously, John and Brook have already touched on market strategy, several of these topics. So I won't go through them all again. Next slide, please. And finally, if you do choose to go down an invoice financier route, not all financiers offer the same package. So make sure you find one that will maximize the amount of money you can generate. You would preferably be looking for one that funds 100% of your export ledger. some financiers will cap that at 30, 40, 50%. The same applies for high involvement in single debtor relationships. Having all your eggs in one basket, they may feel uncomfortable with, so they might cap that again at 30, 40, 50%. Find one with some expert specialist service, those with foreign exchange management, so you can use their foreign exchange accounts to mitigate the risk in exchange movements and fluctuations. Find one that funds worldwide territories and not just the EU. Look for those that will fund OECD and the emerging markets, like those that John and Brook have already mentioned. Language and time zone support. Funders with offices in other countries that can speak the same language and also converse with them at the same time. Otherwise, you're just looking at somebody who can send off an email, which is something you can do yourself. You may also want your trade credit insurance through them as well. So a lot of funders will offer that debt protection. Next slide, please. So thank you very much for your time today. I hope you found everything that John, Brook and I have discussed useful. I'll hand it back.
Great, thank you, Gary, and thank you as well, as Gary said to Brook and John earlier, so much information there. That checklist, Gary, that looks a really useful checklist as well, so it might be one we can hopefully circulate afterwards.
Can I just say, Will, it's Brook. I'm just hoping that we haven't frightened everybody off doing exports, because I mean, if you take our three presentations together, it does sound like it's quite a difficult thing, and not only straightforward but downright dangerous. And I just hope that we've not given you that impression. I think all we're trying to say is this is a bit different from exporting to the EU, and certainly it's different from selling in the UK. And the further you go and the more different the cultures are, the more challenging it is. But that's what makes it interesting, first of all. It's dealing with the people from other cultures and dealing with these kind of issues, which are quite fundamental. But I would say that you got a good product, you got a decent price, and your delivery mechanisms are fine. And this is a very, very exciting activity. So I'm just hoping that we're not frightening you off. What we are saying is that you have to go in to these markets with your eyes wide open. And if you do that and you inform yourself properly in advance, then you will have a high degree of success. Sorry to interrupt, Will. Keep going.
No worries, yeah. As we say at the Institute, we have a saying which is exporting is easy when you know how. So it's all about getting that information and using the support which is out there, because it's doable. You just need to do your due diligence and make sure you've kind of gone through a checklist like the one Gary said, and factored in some of this information which are in these webinars. So yeah, as mentioned, we do have time for a couple of quick questions, not loads of time, but one point which will be a clarification. So from Amanda, the US Chamber of Commerce and another website was mentioned as offering good advice. Could you confirm the second one? I think that was for you, Brook, was it?
No, that was me.
Yeah, go ahead, John.
Amanda, hi. It's called the CIA Fact Book, and it is indeed an open source resource of the Central Intelligence Agency, but it's the benign half of it, and it gives a whole host of useful country data down to the micro detail. CIA Fact Book. Just Google that.
Yeah, it's CIA, like in CIA. I mean, it's like the
Central Intelligence Agency. Yep, CIA Fact.
But they know something about what they're talking about, since that's their business.
Great. Yeah, we're getting a few questions about kind of useful resources for doing due diligence. So it might be maybe we could circulate a list of useful resources afterwards to fellow speakers. So we'll try and do that after. We've had a question in from Graham, which would be for Brook or John again. He's asked, if my distributors are progressing the business via local bribes without my knowledge or agreement, where do we stand?
Happy to answer that one.
You stand on very dangerous ground, because you really need to know what's going on, and if it's too good to be true, then it probably is. John, do you want to add to that?
Yes, unfortunately, you have breached the Bribery Act, the use of intermediaries to pay bribes, particularly if you benefited from them. And there was the case of Maybe Bridge, which was not prosecuted under the Bribery Act, but under the old Corruption Act. And the judge said to David Maybe, the managing director, you should have known what was going on in your position, send him down. And he went to jail for 18 months.
Crikey. Okay. Yeah, good answer. So we've also had a question in from Colin. He's asked, why is it important to specify the country of jurisdiction as the UK in your contract when you will then have to take the case to a local court to rule in it? I'll put that to Gary initially, because I know you talked about contracts. Gary.
Basically, it's about time, expense, and understanding law. I mean, it's a lot easier to obtain a judgment here in the UK than it would be if you tried to obtain a judgment overseas. The expense rockets, the amount of work, documentation, and everything else involved increases if you try and take it into another court. And of course, you don't know the intricacies of the overseas law, and you could find yourself falling foul of some small print law they don't know about that could throw your case out. Whereas if it's in the UK, you've already got the judgment, you've just got to enforce it.
Great, thank you, Gary.
Yeah, please comment on that one very quickly. Law in contracts regarding agents, strong advice, persuade them, and normally they will accept to have it under UK law, because just taking Gary's point one stage further, there are countries, particularly in South America, that will actually favour the local person, i.e. the intermediary, rather than the foreign company. So English law on the whole is benign to both parties. That's not always the case overseas. So to persuade under English law, as Gary said, is more convenient and more cost efficient.
Excellent. Well, I think on that note, we are going to have to wrap up now because we're very much running out of time. Thank you once again to Gary, Brook, and John for the presentation and answers. And yeah, as Brook said earlier, there's obviously challenges involved in international trade, but it is very doable, and there's a lot of support out there, particularly at the moment, for trade kind of around the world. So please do get in contact with us, with Bibby, or look at some of the support from the chambers and the government that's available too. But yeah, thank you again to all the speakers.
Thank you.
Thanks very much.
Great. Well, in terms of what the Institute of Export and International Trade are up to at the moment, we are of course running several Brexit-related training courses in the lead up to the October 31st deadline, many of which are fundable by government grants. I'm sure you won't need reminding of the enormity of what's ahead, but you really do need to ensure you've got the core export skills needed covered, like completing customs declarations, for instance. So please do look at the funding available for our training courses and the training page too. Some of you will also know that the new Incoterm 2020 rules have been released by the International Chamber of Commerce, and we are running a series of training courses licensed by the ICC this autumn to help you stay up to date. And we, of course, have Brook's Risk Management in Markets Beyond the EU course on November the 5th. There's the date. You would have heard about this course earlier, and Brook's also doing a course about the opportunities and challenges of exporting to Russia on November the 8th as well. Both of these are taking place in London. You can find details about...
Can I just, sorry, Will, can I just add, thank you for mentioning that. The Turning Risk into Opportunities course I'll be doing with John who you've just been hearing. The Russia one I'll do by myself, and I think probably will that the web link there isn't the right one. UK Customs Academy.
Yeah, we'll circulate the links afterwards.
Yeah, so it's it should be export.org.uk. Sorry for interrupting. Okay. Thank you.
But you can find details about all of our training courses, as well as our events, membership offerings, and education program at export.org.uk. Next, please. In terms of Open to Export, we're going back to Brexit with 2 webinars in October. Firstly, on the 9th, we're going to be tackling exporting within the EU post-Brexit, and then on the 16th, we're looking at the impact of Brexit on trade beyond the EU. You can find details about all of our webinars at opentoexport.com/webinars. Next, please. Finally, we are currently running an Export Action Plan competition with Bibby Financial Services this autumn. This is a great opportunity for SMEs to win £3,000 towards their export plans. The deadline to enter is November the 5th, ahead of a showcase final in Birmingham on November 28th. For more details about this, please go to opentoexport.com/info/export-action-plan-competition. But that's all for today. As always, please do take our exit survey to let us know what you thought of today's webinar and to give us any suggestions for improvements or future topics. Thank you, everyone, and goodbye.